Hi, I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast. Title of today's podcast could be a little unnerving if you just sort of seen the title on your phone, and it's this. The headline is "Banks are sitting on massive unrealized losses." I saw this headline myself, and I saw it a couple days after I got back from an investment conference I went to down in Florida. And a lot of the talk at the conference from stage anyway, not from the advisors. I must say the advisors, I don't know if the word proud is right, but I love it when I'm in a room full of advisors and we can look with, skepticism, right? Is what's being talked about from the stage. And what was being talked about from the stage were a lot of products that were very reliant on banks, being solvent. And now let me just say this. I'm not afraid of the US banking system. Okay. I don't think we're on the cusp of, a global financial crisis, although nobody knows. That's the whole thing about any of this is nobody can predict the future. Me, you, nobody. But I'm not trying to alarm you about banks. What I do want to point out is a few things. One, let me give you some data. So let's see. This is all coming directly from the FDIC quarterly banking profile. I got this Q4 2024, Q1, 2 in 2025. And then the Office of Financial Research also released the State of Banks Unrealized Securities Losses. This is from May of 2025. So this is real data. This isn't like, rounded numbers. This is government data. So first, for some context, unrealized losses at U.S. banks in 2020, that number was at 50 billion. In 2021, it was at 30 billion. In 2022 was the peak. It was 515 billion, 515 billion, 10 times what it was in 2020, just in 2 years. Why? We'll get to that in a second. 2023, 400 billion. Q4 2024, 482 billion, so almost right back to the way it was in 2022, that peak. And then Q1 of 25 was down to 413 billion. Q2 of 25 was down to 395 billion. So we'll just call it $400 billion right now, okay? All right, so we went from 30 billion in 21 to 515 billion in 22. What happened? Well, inflation happened. Okay, so what was going on, and if you're a client of mine with portfolios with me, you'll understand where I'm going with this. When interest rates were low, for over a decade, incredibly low, clients, the money market rates were essentially zero. Short-term bond rates, high quality short-term fixed income bonds, which is what we use in our portfolios, they weren't yielding hardly anything because that's just what the interest rates were. They were very, very low. It's at one point, treasuries were almost at zero, if not at zero. So there's just no yield to be had. Now, let me say this too, for those of you who aren't clients of mine, or maybe you're an advisor who's new and you're just listening to this for the first time. The point of fixed income in a portfolio is not yield. It's not return. If we want return, that's a factor we get in equities, not in bonds. The job of a bond is to reduce volatility. It's not to produce return. Whatever return you get is great, but that's not what we're looking for. And so when you build a portfolio, we're going to take our risk in other factors. We're going to look at market capitalization. We're going to look at momentum and profitability, but we're not going to look at fixed income for return. Fixed income is going to be high quality, short term. And back when rates were low, they were yielding nothing. Well, if you're a bank and you have depositors and you're not giving them any return and they're demanding return, the bank is going to do what the clients want. They're not necessarily going to go push back and say, hey, look, it's not good for you. If we go get higher return, this is probably not good for you. We don't want to do that to you. They just went and did it because they didn't want to lose their deposits. And so what they went and did is they took a lot of 30-year and 20-year risk. And they were, quote, pushing out the yield curve. They were buying long-term bonds, which were producing a little bit more return to keep their clients happy at the time. The problem is inflation skyrocketed and then held. It wasn't transitory, right? Not the Fed was telling us it was transitory. It wasn't. It spiked. It spiked in 2000, really at the end of 2001, going into 2002, And when inflation goes up, when new bonds are being issued, those new bonds are being issued at higher interest rates. So just think along with this, right? Let's say a bank goes out and buys a bunch of 30-year bonds that are paying 2%. And at the time, that's very high. But then a month later, a new issuance of bonds comes out, 30-year bonds at 3%. Well, nobody wants your stinky 2% bonds anymore. Sure, if they hold them for 30 years, they're going to get their coupons, they're going to get their 2%, but nobody wants to actually go buy those right now. So the value of those bonds in the open market drop, and they drop significantly. And then inflation kept going up, and so 30-year bonds went higher and higher and higher, which made those quote unquote stinky 2% bonds or whatever they were trading at not nearly as attractive. So what did that mean for these banks? Well, what it meant was that they were sitting on a lot of worth less, not worthless, bonds that were worth a lot less than what they bought them for. Now, that's fine as long as you hold the bond until its maturity. The problem is people wanted their money. So this is specifically a Silicon Valley Bank. If you remember back then, what happened, there was basically a run on the bank because somebody in Silicon Valley, I know who it was, I just don't want to say it on the podcast, came out and said, hey, you might want to go get your money. And so people did. And so the bank didn't have the cash. They had to actually sell the bonds in the open market to raise the cash to pay back their customers. And so those bonds just, they crashed. Right now, okay, so that all happened. Everything I just talked to you about, that was 2022 when unrealized losses at banks were sitting at 515 billion. In 21, the year before, it was 30 billion. So a huge spike, right? And we've stayed very high. So 400 billion, then last year was 482, and we're sitting at about 400 billion right now. Why am I bringing this up? Well, a couple reasons. Number one, if we may brag a little bit, if you're a client of mine, this is not a huge, it should not be a huge concern of yours. Okay. These banks are sitting on very, very large unrealized losses right now. They're astronomical numbers. That may not ever materialize into anything, right? It could be fine. The banks could slowly unwind that over time, and it couldn't be a problem. It might not be a problem at all. But what happens if there is a run on a specific area or a specific bank or something like that? It could create a problem for those people. Now, in your portfolios, again, we don't own those 30-year long-term bonds. We don't have that standard deviation, that movement that those long-term bonds do. We're very short-term. You're not going to have standard deviation or movement like that in your portfolios on your fixed income side. But there's another reason why I'm bringing this up. Going back to that conference, the things that were being spoken of from stage there were heavily, it was things that were like mortgage-backed securities. It was certain kind of bank notes that were structured in a very specific way. And they all sound great. And I'm not saying that they're not good. They might work out perfectly fine. But a lot of this stuff is based off of the strength of the bank, of the issuing bank. Well, it might work out fine. But for me and for my clients' portfolios, I'm not looking for fancy. I'm looking for things that I know is built on science and long-term. We know how equities move. They go up and they go down over time. But if we can spread the risk over thousands of securities across the world and across different capitalizations and all, I mean, we're in a much safer position than putting a bunch of money into a single product, maybe being backed by a specific bank. I don't care what the name of the bank is. When you've got Bear Stearns and Lehman Brothers going bankrupt in 2008, it's a real problem. So the biggest of the big can have these kind of problems. And so my message to you is this: you might start hearing some of these things in the news. You might, get an email newsletter about them. Heck, somebody might call you. A broker or whoever might call you and talk to you about these things. If you're curious, call us. We'll walk you through them. We've looked at them. It's not something I think that most of my clients need in their portfolio. If you're a newer advisor and you're sort of looking at these things, I would be telling you to look at them skeptically, not because they're bad, but because you need to look at them in context of really what's behind them. And do we need it? Or do we just need a diversified portfolio that we rebalance over time that is built specifically to the risk that your client is willing to take? I'd submit that's what your clients need.
Registered representative and financial advisor at Park Avenue Securities LLC, OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California 92121, 619646400. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners LLC is non-affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services LLC, DBA of Westpac Wealth Partners LLC. California Insurance License Number OD 34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Past performance is not a guarantee of future results. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market interest rate, issuer credit, and inflation risk. Indices are unmanaged and one cannot invest directly in an index. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. 854657441, expiring 1027.